Something important is changing in banking, and the mistake most people make is that they either ignore it completely or turn it into a panic story. Both reactions are dangerous. When a financial system changes, the right response is not fear. It is understanding. It is to look at the machine, see how the incentives work, see where the pressure points are, and then arrange your life so that one failure in one part of the machine does not trap you. That is the principle I want you to hold in your mind. Most people think a bank account is simply a place where money sits until they decide to use it. That is not quite how the system works. When you deposit money in a bank, you are not putting cash into a personal vault with your name on it. You are becoming part of a system of promises, claims, regulations, insurance limits, reporting rules, and emergency powers. For many years, most people did not need to think about this. The system felt stable enough. Banks were there. Government stood behind them. Deposits moved. Transfers cleared. Cash could be withdrawn. Accounts stayed open. If a bank got into trouble, people assumed the government would step in and make depositors whole. That assumption is no longer enough. I am not saying that the banking system is about to collapse tomorrow. I am not saying that people should run to the bank or act emotionally. I have learned over many cycles that emotional decisions are usually bad decisions. But I am saying that the rules of the system have changed in ways most ordinary people do not understand. And when rules change quietly, the people who do not pay attention are usually the ones who suffer the most. There are several changes happening at the same time. Each one by itself may seem manageable. But when you put them together, they create a very different environment for anyone who keeps significant money in banks, moves money across borders, uses cash, or simply wants access to their own funds without delay. The first change is the shift from bailouts to bail-ins. For much of modern history, when large banks got into trouble, the public expected governments to rescue them. That is what people saw during the 2008 financial crisis. Governments and central banks intervened on a massive scale because they believed the cost of allowing major banks to fail would be greater than the cost of saving them. That approach created an obvious problem. If banks could take risks and then expect taxpayers to carry the losses, the incentives were distorted. After 2008, regulators tried to solve that problem by building a different mechanism. Instead of only relying on bailouts, many countries adopted bail-in rules. A bail-in means that when a bank faces severe losses or insolvency, losses can be absorbed from inside the bank. First, the shareholders are hit. Then certain bondholders and creditors are hit. And in some situations, large uninsured depositors can also be exposed. That last phrase matters. Uninsured depositors, most people do not think of themselves as creditors of their bank. But above the insured limit, that is effectively what they are in the United States. The standard FDIC insurance limit is $250,000 per depositor, per insured bank, per ownership category. In many other countries, the limits are different and often lower. In the European Union, the standard protection is around €100,000 in the United Kingdom. It is £85,000 in Canada. It is 100,000 Canadian dollars for many categories. Those numbers sound large until you imagine a business owner, a retiree after selling a home, a family holding proceeds from an inheritance, or a person who simply kept too much cash in one institution because it felt convenient. Everything above the insured limit is not the same as money protected by deposit insurance. It is an unsecured claim against the bank. That does not mean every uninsured deposit will be taken in a crisis. Systems are more complicated than that. Governments often intervene to prevent panic, but the legal architecture matters because it tells you who is protected automatically and who is merely hoping to be protected. The principle is simple. Never confuse convenience with safety. A single large bank account may feel simple, but simplicity is not the same as resilience. A resilient system spreads risk. It knows where the limits are. It does not assume that because something worked in the last crisis, it will work the same way in the next one. This is why wealthy families pay attention to where their deposits are held, how accounts are titled, what insurance limits apply, and whether their cash is concentrated in one institution, one country, or one currency. They are not always smarter. They are often simply more aware of the plumbing. The next change is the quiet expansion of dormant account rules. Most people think the only way to lose access to a bank account is through fraud, legal action, or a bank failure. But there is another route that feels much more ordinary. If an account sits inactive long enough, it can be classified as dormant. Once that happens, unclaimed property rules can come into play, and in many places, funds can eventually be transferred to the state. Usually there is a process for reclaiming the money. But anyone who has dealt with bureaucratic systems knows that getting money back can be slower, more frustrating, and more expensive than preventing the problem in the first place. The important point is that dormancy periods are not the same everywhere, and in some places they have been shortened. A period that used to be 7 years can become 3. A system that used to focus only on bank accounts can expand to investments, insurance balances, and other assets. When policymakers look at dormant assets, they often see unused pools of money. When individuals look at dormant assets, they see family savings, old accounts, forgotten balances, and money that may have been meant for children or heirs. This is one of those risks that does not feel urgent until it has already happened. Maybe an older person opened an account decades ago. Maybe a family moved. Maybe a relative died and heirs did not know the account existed. Maybe the owner became ill. Maybe statements went to an old address. Maybe the bank sent notices that nobody saw. Then, years later, the family discovers that the account is no longer where they thought it was. The principle here is also simple. Assets that are not organized are vulnerable. A strong financial life is not only about return, it is about control. It is about knowing where the assets are, who has access, what the rules are, and what happens if you become sick, disabled, unreachable, or dead. That may sound basic, but most families do not have a clear inventory. They have accounts scattered across institutions. They have old retirement plans, small bank accounts, insurance policies, brokerage accounts, and paperwork that nobody has reviewed in years. In a world where dormant account rules can move faster, that disorganization becomes a real risk. Then there is civil asset forfeiture and asset freezes without a criminal conviction. This is one of the areas where the gap between what people believe and what the law permits can be very large. Many people assume the government can only take or freeze assets after a person has been convicted of a crime. In many countries, that is not always true. There are systems that allow authorities to freeze or seize assets before a final conviction, and sometimes without bringing a criminal case at all. The names and mechanisms differ by country, but the effect can be similar. The money becomes unavailable while the process plays out. These laws were often created to target organized crime, corruption, money laundering, and fraud. Those are real problems. A society needs tools to fight them, but tools that are built for serious wrongdoing can sometimes touch people who are innocent, poorly documented, misunderstood by an automated system, or caught in a dispute they did not expect. The important risk is not only that money might ultimately be lost, it is that money can become frozen at the wrong time. If you are wealthy, a frozen account may be an inconvenience. If you are a retiree living on fixed income, a small business owner trying to make payroll, or a family facing a medical emergency, a frozen account can be devastating. This is why the principle is not paranoia. The principle is redundancy. You do not want your entire life dependent on one account, one bank, one jurisdiction, one payment method, or one administrative decision. You want a structure that allows you to keep operating if one channel is interrupted. The next major change is capital controls. People in stable countries often believe capital controls are something that only happen far away. In fragile economies with weak institutions, history shows that this belief is too comfortable. Capital controls can appear when governments and banking systems face severe stress. They can limit withdrawals, they can restrict international transfers, they can block or delay foreign currency conversion. They can trap money inside a banking system or inside a country at exactly the moment people most want flexibility. There have been examples in developed or relatively advanced economies. During the Cyprus banking crisis, withdrawal limits and transfer restrictions were imposed. During the Greek debt crisis, ATM withdrawals were capped. Iceland imposed strict capital controls after its banking collapse, and those controls lasted for years. The lesson is not that every country will impose capital controls. The lesson is that when stress is high enough, governments will prioritize system stability over individual convenience. That is how systems behave. When the system is calm, individuals have freedom. When the system is under pressure, the system defends itself. If all your liquidity is in one country, in one currency, inside one set of banking rules, then you have accepted a single point of failure. You may not think of it that way, but that is what it is. Some people respond to this by trying to move everything offshore. That is usually an emotional response, and emotional responses create different risks. A better approach is to think in terms of legal, transparent diversification. If you have meaningful assets, it may make sense to understand what portion should remain in your home banking system, what portion should be spread across institutions, and whether there is a legitimate reason to hold funds or investments in another stable jurisdiction. That must be done legally with proper reporting and tax compliance. The goal is not secrecy. The goal is resilience. Then there is the growing restriction of what individuals can own, hold, or access. Governments and regulators increasingly shape how people can hold certain assets. They do this through tax rules, reporting requirements, investment restrictions, and limits on certain products. Some of these rules are designed to protect consumers. Some are designed to prevent financial crime. Some are designed to preserve financial stability. But the practical effect is that the range of choices available to an ordinary person can narrow over time. You can see this in the way foreign funds are treated in certain tax systems. You can see it in the scrutiny around cryptocurrency and stablecoins. You can see it in reporting requirements for foreign accounts, gold transactions, digital assets, and cross-border transfers. The stated reasons may be reasonable, but the outcome is still important. The more rules accumulate, the more difficult it becomes for a person to move freely, diversify freely, or hold assets in the form they prefer. This does not mean the answer is to chase every new asset or rebel against every rule. In investing and in life, operating outside the rules is usually a very bad bet. The better response is to understand the rules and build within them before they become tighter. A system thinker does not ask, how do I escape every rule? A system thinker asks, how do I remain flexible in a world where rules are likely to keep changing? Then there is currency debasement and the potential rise of central bank digital currencies. This one is different because it does not always feel like a banking rule. It feels like the background condition of life. When central banks and governments expand money supply faster than the real economy grows, purchasing power declines. When inflation runs above the interest you earn on deposits, the real value of your savings falls even if the number on the account statement does not change. This is one of the most important lessons about money. People focus on nominal safety and ignore real loss. They say, I did not lose money because my account still says $100,000. But if that $100,000 buys much less over time, they did lose money. The loss was just hidden. It did not arrive as a bank statement showing a negative return. It arrived as higher prices for housing, food, insurance, medical care, travel, energy, and everything else. That is currency debasement. On top of that, many central banks have studied or explored central bank digital currencies. The future use of these systems is still debated, and it would be wrong to pretend that every possibility is certain. But the reason people pay attention is that digital national currencies could create tools that do not exist in the same way today. Money could become more programmable. Payments could be more traceable. Policy tools could become more direct. Restrictions could potentially become more targeted. Some people see that as efficiency. Others see it as control. Both things can be true depending on design. The principle here is to separate what is known from what is possible. Known inflation risk already exists. Potential digital currency tools may or may not develop in the most restrictive way people imagine. But if you are responsible for your own financial future, you cannot ignore the direction of travel. Money is becoming more digital, more monitored, more integrated with policy, and more connected to identity and reporting systems. That means the old habit of leaving large amounts of wealth in cash or deposits and assuming the system will always treat you the same way is not a good plan. Then comes the increasing reach of tax authorities and cross-border information sharing. Every developed country has mechanisms that allow tax agencies to pursue unpaid taxes. In some cases, freeze accounts. International agreements have made financial information more visible across borders. Banks report more. Countries exchange more. Financial privacy, as it existed decades ago, has been reduced. If you are following the rules, paying taxes, filing correctly, and reporting what must be reported, this should not be viewed as a reason to hide. It should be viewed as a reason to be organized. The danger for compliant people is not usually that they are doing something intentionally wrong. The danger is that they cannot explain what they did clearly enough when questions come. A transfer overseas, an account in another country, an investment structure, a family gift, a business sale, a crypto transaction, an inheritance, a trust distribution, or a large deposit can all be legitimate. But legitimacy is not always obvious to a reviewer who sees only data points. The solution is not secrecy. The solution is documentation. You want records, you want tax advice, you want clear purpose, you want consistency between what the bank sees, what the tax authority sees, and what your returns say. When those things line up, the risk of a problem declines. When they do not line up, even innocent activity can become expensive to explain. Then comes transaction monitoring. Every modern bank monitors accounts for suspicious activity. This has existed for a long time. But what is changing is the speed, scale, and intelligence of the monitoring. Systems are moving from simple threshold-based rules to behavioral analysis. They look for patterns, they compare your current activity to your past activity, they may look at where money comes from, where it goes, how frequently you send it, whether recipients are familiar, whether geographies are considered higher risk, whether your activity matches your stated profile, and whether other institutions have flagged related activity. Many people still believe that if they stay under a certain dollar amount, they avoid monitoring. That belief is wrong. A transaction does not need to exceed a formal reporting threshold to attract attention. A smaller transaction can be flagged if it looks unusual. A series of transactions can be flagged if the pattern looks wrong. A perfectly legal international wire can be delayed if the compliance department wants more information. A cash withdrawal can trigger questions. A transfer connected to crypto, certain countries, or certain business activities can create review. Again, this is not always unreasonable. Banks are required to fight fraud, money laundering, sanctions violations, and criminal misuse of the system. But the ordinary person experiences this not as a policy objective, but as friction. A payment is delayed, a wire is questioned, an account is reviewed, a compliance team asks for documents. In some cases, access to money can be temporarily limited while the review continues. Then comes the sharing and consolidation of financial information. Monitoring becomes more powerful when information does not stay in one place. Banks increasingly work with shared databases, compliance networks, vendors, government reporting systems, and other institutions. Some of this is designed to detect fraud faster, some is designed to prevent criminals from simply moving from one bank to another. But it also means that a problem at one institution can follow you more easily than it did in the past. If one bank decides that your profile is high risk, another bank may become cautious. If one compliance system has questions about your activity, another may ask the same questions. If your transaction pattern is hard to explain, the issue may not remain isolated. This is why your financial profile matters. A financial profile is the story your accounts tell about you. If you are a retiree with domestic pension income and ordinary household expenses, but your account suddenly begins sending large wires to multiple countries, the system sees a mismatch. If you run a business, but your personal account receives business like payments, the system sees a mismatch. If you tell the bank you have simple savings activity but begin moving money through crypto exchanges, the system sees a mismatch. The system does not know your intention, it sees patterns. That means you must make your patterns understandable. Use the right accounts for the right activity. Keep business and personal accounts separate. Keep documents. Tell the bank in advance when a large or unusual transaction is coming. Make sure your stated profile at the bank matches how you actually use the account. These small things matter more than people realize. Then there is de-risking. This is when a bank closes or refuses an account, not because it has proven wrongdoing, but because it decides the customer creates too much risk, too much compliance burden, or too much uncertainty. De-risking can affect people and businesses connected to crypto, international transfers, certain countries, politically exposed persons, cash, heavy businesses, complex ownership structures, or activity that does not fit the bank's preferred customer model. From the bank's perspective, this can be rational if the profit from a customer is small and the compliance burden is high. The bank may decide the relationship is not worth it. From the customer's perspective, it can feel arbitrary and destructive one day. The bank sends a letter, the account will be closed, funds must be moved, access may be limited during the transition. The customer may not receive a detailed explanation. This is a structural issue, not a personal insult. Banks are not neutral vaults. They are regulated businesses with incentives, risk models, and compliance departments. They want customers who fit their model. If you do not fit, even if you are completely legal, you may be pushed out. The principle is to bank where your profile makes sense. If you have complex needs, do not rely on a bank that is designed for simple retail accounts. If you send international wires regularly, use an institution accustomed to that. If you hold large balances, understand how the bank treats large depositors. If you operate a business in a higher scrutiny sector, do not pretend you are a standard customer. Find a bank that understands the activity and can service it properly. Finally, there is the tightening of physical cash usage. Cash has always had a special place in people's minds because it feels direct. You hold it, you spend it. You do not need a payment network to approve it. But across many developed countries, physical cash is becoming more restricted, less convenient, and less accepted. Some countries have imposed legal limits on cash payments. Others have not banned cash but have allowed the private payment system to make cash impractical. Banks close branches, ATMs disappear. Merchants prefer cards. Payment processors push digital systems. Cash handling becomes expensive. Insurance and compliance rules make businesses reluctant to accept large cash payments. The result is that a person may technically still have the right to use cash, but in practice, using it becomes harder. This matters because cash is not only a payment method, it is also a form of optionality. It works when electronic systems fail. It works when cards are down. It works when a person does not want every small payment routed through a database. It works for people who are not comfortable with digital systems. At the same time, cash has real risks. It can be lost, stolen, destroyed, or misunderstood by authorities if large amounts move without documentation. So the right answer is not to hold everything in cash. The right answer is to understand that a healthy financial structure has multiple channels: digital access, bank access, brokerage access, emergency liquidity, legal records, trusted contacts, redundancy. That is the theme running through every rule. The modern banking system is becoming more efficient, more monitored, more automated, and more rules-based. That creates benefits. It can reduce crime, it can speed payments, it can help detect fraud, it can make financial systems more integrated, but it also creates fragility for the individual. The more integrated the system becomes, the more a single flag can disrupt your life. The more automated the system becomes, the less your personal story matters. At the first stage, the more centralized the system becomes, the more important it is to have options. The wealthy pay attention to this not because they believe every disaster will happen tomorrow, but because they understand a simple principle. You prepare before the system is stressed, not after. You do not open the second account after the first account is frozen. You do not learn deposit insurance limits after a bank fails. You do not organize documentation after a tax authority asks for it. You do not create liquidity after capital controls are imposed. You do not build international options after restrictions begin. You do it while conditions are normal, while you are calm, while choices still exist. For an ordinary person, this does not need to be complicated. Start by knowing your bank insurance limits. If your deposits exceed insured amounts, think carefully about whether the excess should be spread across institutions or moved into other appropriate vehicles. Review old accounts, make sure they are active enough not to be treated as abandoned. Make sure your family or trusted representative knows where important accounts are located. Keep records in a place where they can be found if something happens to you. Separate personal, business, and investment activity. Do not make your financial life look more confusing than it needs to be. Use the right accounts for the right purposes. Document large transfers. If you send money abroad, keep the reason. If you receive a large sum, keep the source documents. If you make a family gift, write it down. If you sell an asset, save the paperwork. If you move money between accounts, make sure the trail is clear. If you have meaningful assets, get proper legal and tax advice before you open foreign accounts, buy foreign funds, move large sums, or create structures that have reporting obligations. International diversification can be valuable, but only if it is transparent and compliant. Complexity without understanding is not protection. It is a future problem. Keep some emergency liquidity in forms you can actually access. Do not keep so much cash that you create security problems or reporting confusion. But do not be so dependent on a single digital payment channel that a technical issue or account freeze leaves you helpless. Build relationships with your bank before you need them. If you are going to make a large transaction, tell the bank in advance. If your profile has changed, update it. If you have a trusted contact or power of attorney arrangement, make sure the bank has the right documents. Many problems happen because the bank is surprised. A system that is surprised tends to stop and review. Most importantly, think in probabilities, not certainties. It is foolish to say, nothing bad can happen. It is equally foolish to say, everything will collapse. The rational approach is to say, some things can go wrong. I do not know which one will happen or when, so I will arrange my affairs so that no single event can ruin me. That is how I think about economies. That is how I think about markets. That is how I think about debt cycles. And that is how I think about banking rules. The people who get hurt in periods of change are usually not the people who had less information. They are the people who had information but did not convert it into structure. Information by itself is not protection. Structure is protection. A person with one bank, one account, one currency, no records, no trusted contact, no backup liquidity, and no understanding of the rules is exposed. A person with diversified institutions, clean documentation, legal compliance, clear account purposes, and access to multiple channels is much more resilient. That does not make them invulnerable. Nothing does. But it gives them options. And in a crisis, options are everything. When people lose options, they become forced sellers, they accept bad terms, they wait in lines, they submit forms, they fight bureaucracy, they discover that access to money is not the same thing as ownership of money. That is why these banking changes matter. They are not just technical rules, they are a reminder that money exists inside systems. And systems change. The rules around deposits, dormant assets, asset freezes, capital controls, investment restrictions, currency debasement, tax enforcement, transaction monitoring, information sharing, de-risking, and cash usage all point in the same direction. The financial world is becoming more controlled, more transparent to institutions, and less forgiving of people who are disorganized. You do not need to be afraid of that, but you do need to respect it. If you respect it, you can prepare. If you prepare, you can remain calm. And if you remain calm while others are reacting emotionally, you will make better decisions. That is the real lesson. Do not wait for a banking crisis to learn how your deposits are protected. Do not wait for an account freeze to organize your records. Do not wait for a transfer to be blocked to think about jurisdictional risk. Do not wait for your account to be closed to find a bank that understands your profile. Do not wait for cash to become difficult to use before you build alternative payment options, and do not wait for the rules to become stricter before you learn the rules that already exist. The most dangerous risk is not the one that arrives with a headline. It is the one that accumulates quietly, rule by rule, form by form, system by system, until one day an ordinary transaction gets caught inside a machine you did not know was there. The people who understand that machine early do not have to panic. They simply build around it, they diversify legally, they document carefully, they keep redundancy, they avoid unnecessary complexity, they ask better questions, they think in systems. And that is how they protect their money in a world where the banking rules are no longer as simple as most people believe.